in to the Cash Flow Show with Dave and Nate, the best place to navigate how to achieve capital appreciation with commercial acquisitions. Here's your hosts, Dave SEYMOUR and Nathan Amaral.
Hey!
Hey! What's
Hey!
How you doing?
How you doing? Happy February. Happy
February. What
February.
is it, the 5th?
Can you
February
imagine?
the 5th? You know what that means, right?
I have no idea.
You know what's right around the corner? Valentine's Day.
Oh, that's so true. Do you celebrate Valentine's Day?
I try to, if she lets me.
What do you mean if she lets you? What does that mean?
I don't know.
Well,
I'm not what? How you doing? Oh, come on, Nathan. Catch up, will you? All right?
Wait. Well,
that was a flyby right there.
No, it's funny you mentioned that though. But to keep this totally PG, no, it's funny. The other day, someone said, "Oh, it's Valentine's Day coming up, and what do you do on Valentine's Day?" I said, "I do absolutely nothing on Valentine's Day. I don't even celebrate Valentine's Day."
You know what I do? I stare longingly into my beautiful wife's eyes, and I tell her how appreciative I am.
She must be
she
watching
allowed
today.
me. Hold on a minute. I'm listening. That she allowed me into her life and to participate in a magnificent journey. That's all the crap I got. I got nothing else. That's what I do every year.
That was so sweet.
Buy her a card.
That was so sweet.
Yeah, right. That was a bunch of crap. That's what that was.
Do you really?
What do we do? We try and get like a little date night or something. That's about it.
Yeah. Yeah, that's nice. Like a little restaurant.
I realized yesterday I've been with her for 17 years.
No.
Isn't that amazing?
Wow. That's a long time. Gosh, what do you do with all that time? Gosh.
I don't know. We look at each other.
Has it been great?
It's been incredible all the time. Every second. You know what, though? We had a little incident in the house, and my best plumber ever, Bob Robio, was over the house, and we were just BSing while he was taking care of some business. And it was like, I was just saying to him, 17 years has flown by, Yeah. She was the one who gave me permission to be wealthy all those years ago.
Yeah.
When I started the journey in real estate, if it wasn't for her, none of this would be possible. I wouldn't even be talking to you on this podcast. You know what I mean? I didn't forget the day we were at our Whitney seminar, right? Doing what we were supposed to be doing, and it was an investment in our education, and it was north of $25,000. And I looked at her and I said, "Well, what do you think?" She said, "Well, what do you think?" And I just said to her, I said, "Look, Mary Beth, if we're going to work, if our relationship is going to grow, if we're going to be by each other's side," I said, "I can't keep doing what I've been doing. I got to do something different. I can't trade any more time for money." And something she said to me, I never ever forgot and never will. And she said to me, "Go get him, killer." She said, "I'm proud of you and I love you and I support you in whatever you want to do." And that was the day I looked at her and said, "I'm so glad you said that because I maxed out my credit cards. I got a FICO score of 2. We need to use yours." She was my first private lender. That's what I always say. She was my first private investor. Anyway, so Valentine's right around the corner.
Great story. It's such a great story. I'll tell you one thing though, since we're speaking about your relationship. I remember this time when I was sleeping in your basement. One thing I realized, you guys were talking upstairs, and I forgot what I was doing down there. And I didn't sleep in your basement, just to make everybody clear. You actually put me up in a guest room. I was in the basement at the time setting things up. And you guys had this disagreement about something, but I forgot what it was. But what I remember from that moment was how openly communicative.
Yeah.
That's the point, right?
Yeah.
How open you guys were in your communication in discussing the matter. It was just like everything was on the table. It was like, wow, they communicate very well. That's what I remember.
Interesting.
Yeah.
That's interesting. I don't know if she and I would agree with that today, 17 years later, but look, man. Here's what we have figured out. How do we end up on relationships? We're supposed to be talking about cash flow.
It's Valentine's Day.
Valentine's Day. You know what I did figure out a long time ago was that we both needed to have non-negotiables. You know, some things are just not negotiable. They're not that you don't bend the rules around certain, you know, pieces of our relationship. Yeah. And we both made a commitment when we first started was I used to say to Mary Beth, you take care of you because that takes care of me and allows me to take care of us. Because if one person is dependent upon another person for their validation, for their presence on the planet, you know, you're coming from a place of weakness. So, no, I'll just tell you up front, Mary Beth and I have done a lot of work individually. We've done a lot of work as a couple. And so far it works. It's funny. Not this week, but last week, it was a crazy ass week, man. I mean, it was just nuts. Like my mind was 24/7 absorbed. And we were passing each other, putting the kids to bed, whatever, going through our nighttime routine. And as I walked past her, I think it was in the hallway, she kind of like stopped me and she said, I just need you to realize something. I said, what's that, baby? She said, I've kind of felt like a piece of furniture this week and I need you to fix that in the next week going forward. Okay.
Wait.
I'm like, yeah. And I'm like, okay, I get it. Yeah.
So what did you do? What did you do to fix this furniture?
I apologized. I just apologized. I said, I'm sorry that you feel like a piece of furniture. Like, you know, she's like, I might as well have not been here is the point.
I see what you're saying. I get what you're saying. Yeah.
And it's
I didn't pick up on that cue, by the way. Notice how I didn't pick up on that cue? Like, I would have been thinking like, oh, do you need to redecorate? Like you broke the furniture. Like
this is a level up. You need to come into my coaching program.
This is after the 10. Hey, remember I have a strategy.
Right. That's funny, dude. You're out of your trees. Anyway, do the thing.
Let's do the thing. Welcome everybody to the Cash Flow Show. We are your hosts, Dave Seymour and Nathan Amaral. Thanks so much for being here. This is the #1 place in the world right now where you can learn about how commercial real estate in apartments can help accelerate or increase your wealth plan, your asset allocation, and how you want to build a healthy portfolio secured by what we think is the best form, the wealth vehicle being real estate. And that's what we're here. If you're new, let us know in the comments. Say hello to Darren. What's going on? Darren's already here. And thank you for liking the show. Everybody else has been liking the show. If you're new here, let us know in the comments below. If you have any questions, comments, or funny remarks, you can leave that down there as well. And we're here to talk about some very interesting things, as well as the deal of the week. But we got some unique things.
Deal of the week in a minute, but let's do a little education. Want to do some education?
Let's do some.
Let's get educated.
Yeah.
So, you know, we live in the world of commercial real estate. We're consistently using terminology, abbreviations that are very familiar to us, right? But we did our weekly investor webinar yesterday. Every Tuesday, every Thursday at 2:30, we do that call. Okay. And we dialed in on a topic which I took for granted. And we realized that a lot of investors don't understand what we're talking about. And it's the financing terms that are used in the commercial real estate world. You know, recourse versus non-recourse. And assumptive
What's that,
loan.
Dave?
Yeah, right. Assumptive loans, balloon payments, LTVs, loan to values, et cetera, et cetera. So if you are going to take a couple of notes, I'm going to keep it very high level. I let Walter delve into it yesterday on our call.
Let me, before you transition, I just want to add something there. What I think people also need to realize as you explain this is that, you know, money, real estate has its own language. Just like there's English and Spanish and all that. Money has its own language. Everything you're about to explain is its own language, has its own terminology.
You know what we should do? We should come out with an app. You know, they've got Babbel to learn how to speak French and Portuguese and stuff like that.
Yeah.
We should have an app for money. You know what I'm saying? Like we could do it in a French accent. Learn to value. Répétez after me. You know what I mean? We could do it like that.
Cash on cash, returned.
Cash on cash. Reto. Dinero. Mucho dinero. Gracias. Oh,
Late payment.
All right.
Foreclosure. Foreclosure.
I beg your pardon. Don't you swear at me. Foreclosure.
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 Oh God, I'm crying.
I miss you, dude. It's been so long since I've had these good giggles with you. All right, seriously.
Okay.
Seriously.
Okay.
So, look, when we do a commercial real estate transaction,
Yes.
we can,
Oh God.
first of all, we don't over leverage, right? So 65% comes from our banking relationships. As we've said before, the bank wants what's called a debt service coverage ratio that makes sense to them. And a DCR of 1.25 or better simply means for every $1 the property brings in net operating income, the bank wants to see an additional 25 cents coming in to cover that mortgage payment. So once we get there, we then have a recourse or a non-recourse loan. So we only have non-recourse loans when we purchase, and meaning simply this, it means everybody signs for a mortgage. If you've ever got a mortgage on a property, somebody is personally liable for that. So, you know, you get a mortgage with a bank and, you know, you can't make the mortgage, foreclosure, then that bank is always coming for you, right? They'll either come for you in your credit report, they'll come for you in a tax scenario. It doesn't just go away because you didn't pay it. Whereas in the commercial world, the bank understands that we bought the asset well enough for it to be a non-recourse loan, meaning worst case scenario, everything goes to crap. You know, we personally are not liable. Our investors are never liable for that mortgage because we take all of that responsibility as the GP, the general partners in the deal. The limited partners don't carry any of that liability. Another one of the fantastic reasons why investing in an LP position is good. So recourse, non-recourse. Now, when we look at the interest rates that are out there right now, the banks are offering a ton of non-recourse. Because what happens is, and this is the second commentary, a balloon payment. Most of the loans that are coming into the commercial marketplace today are non-recourse with a 10-year balloon payment.
Yeah.
And the reason that they're doing a 10-year balloon payment, meaning you got to pay up, right? You got to either refinance the loan or you've got to pay off all the debt in 10 years. And we know it's coming, which is why we exit out in 7.
Yeah.
But the reason that they put that balloon payment in there is they are gambling on the fact that the interest rates 10 years from now are going to be higher than they are right now, forcing us to get their liquidity back to the bank so that they can lend it at a higher rate of return. Does that make sense?
Absolutely.
So that's what the balloon structure is about. What's interesting is this is, and I know you've experienced this as well, Nathan. A lot of investors love to learn commercial real estate investing, apartment house investing, right? They love to learn it. They like a good spreadsheet and some analysis and, you know, the population within 3 miles of your subject property and the tax, you know, they love all of that data. But that's really good. And they get all excited up until the point that they've never done a deal before. And then they go to get their financing and the bank says, you got 2 choices. Number one, you get a recourse loan, meaning sign on the line for the 4 million, 2 million, 10 million, whatever it is that you're going to borrow.
Yeah.
Sign on the line. I want all of your children's birth certificates. I want all of your, right? I want all your college money. I want your primary residence. I want your business, every single asset under the sun.
Any asset you have,
Right. They use that for collateral on the loan. And that's where a lot of newer investors freak out and run for the hills.
Right.
Or the other option they have is the bank will say to them, yeah, we'll do this if you get a sponsor. And the sponsor being a qualified GP, general partner, who's done this not once or twice, but many, many times. and brings their credit history, their borrowing history to the table. So that's interesting how that works on a recourse and a non-recourse loan. So we got recourse, non-recourse, balloon payments. Now the next one that's interesting is what's called a loan assumption. Go ahead. Question.
Let's just add question. Let's just talk about what a sponsor is, like a little bit more in detail. As what type of person would that be?
Yeah, so a sponsor is somebody who's got a proven track record in executing on the type of deal that you have. So, the bank could say, yeah, okay, it's your deal, but you need to bring some weight to the table. You need to bring a heavy hitter. Yeah. Freedom Venture Investments, right? Yeah. 25 years experience in the Gulf Coast region, buy-in, build-in, etc. So, there is an alliance that the bank is looking for between expertise and your newness to the arena. So that's really what a GP or a sponsor is. Somebody's got a track record. Sometimes they bring cash, sometimes they don't. But either way, they bring their expertise of executing on the plan that's in place.
Right.
Does that make sense?
Yeah, absolutely. Thanks for sharing that.
What are you reading? What are you doing?
Well, I'm just reading some.
While you're talking to me?
No. Well, I'm just reading some questions. Yeah. So one of the questions that has come up is what? Sorry. Why don't you continue and let me come back to this question?
Okay, it's a long question, isn't it?
It's a long one. Yeah. Okay.
All right. So we got recourse, non-recourse, balloon payment, meaning it's time to pay up on the loan. You'll see, by the way, a lot less non-recourse loans 5 years, 7 years, 10 years out as the mortgage rates adjust, right? We're at the lowest mortgage rate historically we've seen, to 3.25% is their last mortgage that we got down on the 8 contracts that we're taking down. So, it's ridiculous to be that low. The other one is what's called an assumable loan. An assumable loan is, as it sounds, you're selling the asset, Nathan, and you sell it non-recourse and assumable. And you may say to me, there's 3 years or there's 5 years left on this loan. Now, I don't have to go out and generate a new loan. I still have to qualify for your loan and your loan terms. But it's pretty much the same thing in the sense that the bank wants to see a qualified general partner or operator, which is what Freedom Venture is. And then we step into the existing mortgage in place, knowing what all the terms and conditions are.
So
does that make sense?
Yeah, to clear that up, that's more like a transfer. So whatever the existing loan was prior, it's now transferring over to the new investor yourself.
Yeah. The 81 doors that we're closing on next month, consisting of the 55 unit and the 26 unit combined. The 55 has an assumable mortgage on there. I think it's 1.7 mil. Okay. So Walter was just finishing out the assumable application yesterday, actually. So that's all set. That's good to go. And we're walking into the existing financing on that. I think there's maybe 4 years left on that loan, which is perfect because our exit strategy on that is actually a 3-year exit because it's a syndicated sidecar deal to the fund. So there's a lot of advantages in understanding the finance structure. And how we go about doing that going forward, for sure.
Good question. The question that's come up, let me just kind of summarize this, is if someone is investing with Freedom Venture, right? Are they able to say that they're like partnered and that they can they put it on their credibility kit? That's a big, I'm summarizing that.
Oh, absolutely they can. Yeah.
Okay.
Yeah. Because you're now a financially vested partner either in the fund or in the individual asset, depending on which deal you're structured with. So you own it, right? You own the asset. You own a piece of the management company that owns the assets, or you're just a piece of that deal. So absolutely, yes. Okay. Yes. A lot of investors do that. They come with us for their first 1 or 2 deals. They learn. They get to be a part of the Freedom Venture Investor Club, that smaller group that we have. Yeah. And then they get access to some of the deal flow that we don't do. And it just creates a nice win-win situation going forward.
Yeah, and I think that's important to know because I think like we have a lot of, newer people that are watching and they're kind of on this path of like, oh, I'm going to get started and do this. I'm going to go take down my first 100, 200 doors. I'm going to do it all alone. A lot of the things you mentioned, they would have to go out and get it themselves.
Exactly.
Right, their own sponsor and all that. So now it's like if they partner or if they invest with Freedom Venture, they have the opportunity to say, look, I'm in this deal, right? These are my partners.
Yeah, when they're raising their own private equity, which is really why they need the credibility, right? They need the credibility for the banks, and they need the credibility for the retail investor and the smaller institutions, if that's their journey. Yeah. So that gives them that credibility, and the number is real, or the term is AUM. Write that down. AUM.
I don't even own a pen.
Get a pen. Tattoo it on your head. It stands for assets under management. That's your that's your credibility kit right there. So, that investor can now be a part of, 20 million AUM. We're targeted for about 55 million AUM by the end of second quarter. Right. So, that's the stamp of approval that somebody gets when they invest alongside us.
Mm-hmm. That's great. Yeah, I think that's really important for people to know, especially, if someone is trying to, or who they're just getting started. Maybe they have this attraction towards, being in multifamily and they're interested, but yet they don't want to take down their first deal alone because there's a lot of things going on. I like what you just said. There's a lot to it. Sure. Yeah, you guys have over 20 years of experience doing this. So that's someone people can lean on. And it also helps build confidence too, right? So they're in exchange for that partnership. They're just taking their capital, partnering with Freedom Venture, and then, saying, hey, look, this is on my credibility kit. This is what we're doing.
Yeah. It gives them, it gives them the ability to stand in truth, right? When they're talking in any network environment or, business environment. A lot of our investors are business owners, restaurants and lawyers and doctors, dentists, things of that nature. Right. And, they like to brag. It's just this. I'm just going to go right at it. Right? They like to brag. Yeah. They like to tell their peers, I'm getting targeted double-digit returns in commercial real estate, invested in Florida, blah, blah, blah. And I see them begin to talk about forming groups, like investment groups or investment clubs and that kind of stuff. Right. And that's always interesting to watch that because it's spreading the good word. You know what I mean? So
yeah, absolutely. Yeah. Well, speaking of bragging, I'm sure they brag about not only the percentages they're getting, but also about maybe on the amount of units. Let's transition here into the deal of the week. Are you good?
Pull that puppy up. I love this one. I love this one.
We got a nice one here.
This one is in. It's a smaller one. It's funny. We're seeing some incredible opportunities pop in the smaller unit class. As you know, we primarily look at 40 to 150 doors. But some of these properties that we're seeing now, it's the mom and pops that we've been talking about. It's the pre-foreclosures. It's the estate sales. All of this stuff is coming to market. So we're actually up in Pensacola on this one, which is
that's a little right.
It's a little bit of a trip, but we got feet on the street, we got infrastructure there, so we're not concerned about it. But this is luxury apartments. This thing, it's a beautiful property, all 2-bed, 2-bath, beautiful layouts, high-end finishes and appliances in it. It's got the stainless steel GE monogram appliances, which is a nicer package for GE. Already got your granite, your high-end vinyl plank flooring in these apartments. It's just a really, really nice unit or complex. Completed in '99. The current owner acquired the property in 2016, so they've had it for 5 years. And it's during that 5-year period of time that they just put all of this money into the property, ton of money into the property, upgrading everything. Like I said, the carpentry, flooring, fixtures, as I said, the appliances. So they just did a cabinetry. They just did a really nice job. What's interesting is this property is being liquidated as part of corporate restructure. So I've said this a couple of times on our calls, Nathan, but I'm going to highlight it again. This is a deal that nobody else is looking at. This is coming through the relationships that we've built over 25 years in the Florida market, primarily down in the Gulf Coast region.
Yeah.
But if through association a deal like this comes up and it's in Pensacola instead, then guess what? We're going to take it down, right? We're going to take it down. So this is the pocket listing that we talk about. I got another one that I'm signing an NDA on later on today through a relationship, but it's 242 doors in San Antonio, Texas.
Whoa!
But this again, right? This again is, it's a pocket listing. I get first look at it to run the analysis, but this is just a sweet little deal. The property completed 99, like I said. The property will be acquired for about $2.4 million is our target acquisition price. We've got an LOI out on it now, and we're negotiating, but we're pretty confident we're going to be somewhere around that price point. Okay. The problem is it suffered really bad maintenance. Okay,
is that because it's near the water by chance? It's like
no. When I say maintenance, I mean maintaining the tenancy. Maintenance in the sense of a tenant has an issue and nobody's picking up the phone. Okay. It's been in a receiver took it over, and the receiver is nothing more than a penny pincher. They are not a property management company.
Right.
So it's been mismanaged. There hasn't been good maintenance available to the tenants, and in a high-end unit like this, if they're not getting service, they're gone. And what's happened is it's led to a 75% occupancy rate on this property. So, look, you and I both know that 25% vacancy represents 25% of free real estate to us.
I was going to say opportunity. Right? Yeah.
It's opportunity. It's huge, Nathan. It's huge opportunity. So we estimate an additional maybe 50,000 to 60 we'll put into it. Exterior repairs, taking care of the challenges that have not been taken care of up until this point. But once the repairs are done and we've got our professional management team in place, that 25% vacancies will fill immediately. We expect a 30-day turn once that's completed. We did do a feasibility study on the market, and this particular property in this particular part of town is incredibly valuable. It's in very high demand. So when we take all of that information and our plan to buy and reposition it, the average cash on cash return for our investors over a 5 to 7 year hold is coming in at about 14.25%. The rate of the money working over time, or the IRR, the internal rate of return, calculating out just shy of 25%. And if you look at the equity multiple, that's what's showing you the value of the 75% occupancy. Because when we get it up to 100% and fill the other units, the equity multiple on exit for this is around a 2.2, meaning for every $1 that an investor puts in with us at Freedom Venture, when we sell and liquidate out of this asset, 72-month hold targeted, they'll get their $1 back plus an additional $1.20. And that's how you get your 2.2 multiple on there. So I'm excited. I'm loving these little deals because and here's the other thing. And I don't think I've ever mentioned this, but this is a game changer, Nathan, an absolute game changer. 72-month or a 5-year hold, somewhere around there, right?
Yeah.
5 years from now, my buyer pool for 24 units, will it be larger or smaller than the buyer pool for 250 or 500 units? Will I have more buyers for a smaller asset than I will for a large asset? And the answer is what? Yes. More people can qualify for a smaller asset than they can for 250, 300, 500 unit, right? True. You've got a smaller buyer pool for those larger assets. Sure. So being able to liquidate out of these things is a lot more confident. There's a lot more confidence in that exit strategy for us, which is why we love the smaller units. From the this is 24, but from the 40 to 150, my buyer pool is a lot higher as well.
Right. Yeah.
So I love this little deal.
A lot of the properties that you have shown are typically under, I think from what I remember, there was only one that was like 200 units, I think, off the top of my head. Yeah.
Yeah.
Maybe I could be off at that number. Yeah. One of the things I wanted to ask because I know this comes up quite a bit. So if we could run like an example of $100,000 investment, right? So if we were to run these numbers and someone has maybe 100,000, maybe they have 300,000, however much money they may have, and they say, you know what, I want to try this, I want to get involved. Let's just keep the number simple, 100,000. So if someone invests 100,000, what would they expect in regards to equity multiples or stuff like that?
That's a great question. Yeah, great question. So again, these are targeted returns. We're all in real estate. We know that there are no guarantees, right?
Right.
But we are guaranteed to put the money to work. So $100,000 in the example you see here, at the end of the investment, either 5 years or 72 months. We'll go with 72 months because that's how Walter ran the numbers on this. For the $100,000 that the investor put in day one, when the investment is over and we sell it, they will get back over time, including their cash on cash return and everything else. They will get back $220,000. Not all in one lump sum, right? But they get their equity back, which is the 100,000, and then their cash flow over time, plus the equity at the time of sale, their percentage equity at time of sale, how much of the profit they get, puts them in a position where they can expect to see 120,000 back on the 100,000 that they put in. Does that make sense?
Yep, absolutely. Yep.
So let's do 300. Let's do 300,000. So if they put in 300,000.
Yep.
300,000 will give them. Look at me being a smart guy. So 120 times 3 is 360. So 300,000 will give them back 660,000 at the time that the investment is liquidated.
What now? When it says 72-month hold, what does that mean?
It means that when we look at this asset, we say, what's our very best way to monetize it? Is it a 1 year hold, 12 months, we get in, reposition it and sell it? Can we do better with it over 3 years, 5 years, 7 years? So we look for the fund. This will probably go into the fund rather than a sidecar deal. But when we look at this, it fits nicely into our fund exit strategies because we target 2, 2.2, 2.4 for a multiple. So our fund says we're going to work this money for our investors over 5 years. Gives us 5 years to raise the rents, eliminate any management challenges, do the repairs that needed to be done on the properties that are inside the fund. The reason that we extend out to sometimes 7 years is because we don't want to be forced into a position where we have to sell it because we said it was 5 years or we said it was 3 years. We want to be in a position where we want the very best amount of return to our investors. So we give ourselves a little bit of a leeway on selling the asset. So we're going to hold on to this thing for that period of time. And then we're going to sell everything because the fund is now closed. It's done. We're on to our next fund going forward.
Nice.
Yeah.
Great.
Yeah. It's a beauty.
It is a beauty. They're all beauties, actually. They've all been great deals.
Yeah. Yeah, they are great deals. Walter's a rock star, man. I'm excited. I'm going down not this week, but next. Yeah. Okay. Next week. Nice. You know what's crazy? I did a phone call. It was a networking phone call with a young lady from California. She's in whereabouts is she? I think she's in Orange County. But anyway, she's one of the top realtors in California for residential. And she was connected to me through Kevin Harrington, as you know, from Shark Tank, part of our team. And we were just having like a networking call, which turned into you know what, why don't I offer her a chance to come to Florida and come walk these properties with us? Then she has a production company that's also coming out there. Okay. And because what she wants to do is not only does she want to invest with us, but she also wants to be able to take the education of walking these properties back to her investment community in California because everything's so overpriced, they can't get a return on the investment out there. And she's like, I want to up my game now to the next level. I want to be playing in the, the $5, $10, $20 million sandbox with you guys. So yeah, it's going to be a good trip. I'm excited to do a little filming with them. Yeah.
Yeah. They're looking for alternative areas, that's alternative markets.
Yeah. So I see you've pulled up the website. That's freedomventure.com. Freedomventure.com. You can go there, click on any one of those buttons, get yourself some education, some great podcasts on there. Some good. That's actually a good. Scroll up again there, Nathan. That video right there, real estate investing. That video is probably one of the best videos to watch to break the ice as to what we do. We shut that down at the Bradenton complex latter part of last year. Just a really good understanding of what the fund does, how it does it, why we do it, where we do it. So that's a really good video to watch. Punch in your email, your phone number, get updates, weekly updates, deal of the week updates. Just a really good chance to get some information from us. Yeah, just add some info in there. If you actually scroll down, there's a book in there as well. Is Private Equity for You? It's probably on the front page, not that page. Yeah. But there's a chance to download a book there as well. So there's some good stuff. Some good stuff in there. Team articles. Go down. There you go. Download that book. Talks about private equity, real estate, and its place in a balanced portfolio. That's a high level conversation in that book. I spent a lot of time putting that together, so enjoy it. But yeah, we're open for business. You can call me directly, 781-922-4418. One of my team will answer the phone and coordinate a time to speak to either myself or maybe Walter. So yeah.
Nice. Good stuff.
Very good stuff.
Are you still doing those meetups by chance? It was, but we just kept going.
It was frozen.
It was frozen for a second.
That's all right. Look at that face. That's not a pretty face. That's unpleasant. Yes, we're doing meetups. We're doing them online now.
Okay.
So you'll also be notified of that. Great chance to set up an investor call with one of our team members. Just a 15-20 minute intake. See if we can help you out.
Nice. Good stuff. All right. Fantastic.
Brother. Yeah.
Mike.
Yeah.
It's been great. It's been good. It's been real good. Dave, I hope you have an awesome weekend.
You too, my friend. You too.
And make sure you get some. Make sure you get some flowers. To make.
I will. You too. See you, brother. Bye.
All right. See you.